This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
How often have I said that as investors, we're often our own worst enemies? Study after study have shown that emotions impact returns more so than even the savviest investment selection. Up next, there's some common misperceptions circulated that I'm absolutely convinced will be injurious to many portfolios heading into 2024. The more we can be self-aware, the better off we'll likely be. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. Happy holidays, Merry Christmas, Happy New Year, all those things. Hope you're having a safe, relaxing, and festive holiday season. A lot to get to today. You know, I never claim to have all the answers. Try to be as humble as I can on this show. But in my mind, there's some pretty common misperceptions kind of circulating that I'm seeing in the press, that I'm hearing from clients, that I want to make sure I kind of bring to light, because as I mentioned, the more we can be self-aware going into 2024, the more we can harness our emotions, the more we can avoid knee-jerk reactions, I think the better off we're going to be regardless of what happens. So I want to get to that. But in the meantime, I thought I'd just mention that, of course, we're in the midst of a pretty strong year-end rally here that started late October in both stocks and bonds. Remember, the market kind of peaked in late July. S&P, I think, declined almost 12% from peak to trough through about mid-October. At the same time, bonds were getting killed because the 10-year Treasury went from about 4% to almost 5%. And, of course, prices go the other way. So it was a very difficult late summer, early to mid-fall. But since then, both of those things have reversed. Rates have come back down. 10-year Treasury is under 4% as it stands. Inflation readings have been cooler than people expected, I think, by this time. And the Fed has taken a dovish turn for sure. So stocks and bonds have responded in kind. Remember what I always say, right? And I've been saying this for years. According to Ned Davis research, each year, if you go back 100 years, each year the market sees on average about 3% dips. Stocks correct about 5% or more 3 times a year. About once a year, you get a 10% correction and a 20% bear market about every 3 years, okay? Understand this is par for the course. So when we get sell-offs, they do not always lead to crashes. And I said that back in September, October. Remember this going into next year because undoubtedly we'll see more volatility. Many times it's a reason to hang in there and maybe even do a little bit of buying. We'll see. But not only has the market rebounded, but also expectations have rebounded. I was just reading something from Goldman Sachs this week. Back on November 15th, they put out an S&P 500 target for next year of 4,700. Well, just a week ago, just a month after their 2024 forecast, they took that target from 4,700 to 5,100. Citing that real yields are going to stay low and support a price-to-earnings multiple of about 19, almost 20, which is a little higher than where it is today. So, not only has the market gone up, but Wall Street analysts are playing catch-up. These are not negatives, okay? These are not negatives, but I will say, and I think my colleague Chase Hinderstein, my co-host Chase Hinderstein, will talk more about this next week. You still need to be prudent and careful, I think, going into next year. For one, this kind of soft landing narrative, right? The idea that the Fed is going to be able to raise rates and bring down inflation without triggering a major economic slowdown has become almost consensus, right? I know there's some outliers, but the vast majority of Wall Street forecasts, the vast majority of talking heads are all saying the same thing, that the Fed might actually be able to pull this off. And I think this pretty strong rally over the last month and a half or so prices in a lot of that expectation. So even if we do get a soft landing in 2024, it's possible that maybe stock returns are not going to be quite as good as what you might have expected because we've kind of front-run that story. And of course, if we don't get a soft landing, if we get a significant economic downturn for whatever reason, that is not priced into the market. at this point either. So again, I'm not being negative here. I'm just saying, hey, listen, I don't think this is the time to throw caution to the wind, start investing all your cash. Same thing on the bond side. I mean, bonds have had a major rally here. I think if you look at the Barclays Aggregate Credit Index, up almost 9% just in 2 months. Well, given where yields are, I mean, that's about, give or take, about 2 years of expected returns in 2 months. Okay? Now, obviously, we have a lot of fixed income on the books. Many of our clients have a lot of bonds and preferred stocks and other fixed income on the books. And we're happy to see the rebound. But it would not surprise me if rates don't go straight down from here. In other words, we probably overcorrected to the upside over the summer when rates went above 5%. It's possible we overcorrected a bit to the downside with rates now around 3.9. So again, would not surprise me at all to see some moderation in stocks and bonds over the next few months. And as I mentioned, we should expect that. We should expect those 3% plus dips that we've seen on average for the past 100 years. Don't be surprised, and obviously we'll be here to talk about it. But let me get to the topic at hand. This is not an exhaustive list, certainly, but there are kind of 6, I've called them misperceptions that, again, I'm hearing, I'm seeing, I'm reading, that you're probably aware of as an astute, wise investor, but sometimes it's good to kind of look in the mirror a bit, make sure that we're not falling victim to some of these things, right? Because as I've said a million times, I said it at the top, I think harnessing emotions is just as important, if not more important, than picking the right stock, investment, even having the right asset allocation. So with that in mind, I think one big kind of misperception is that whole kind of, I guess it's a saying. It's not really a truism because it's not true, but it's a saying that what goes up must come down. Okay, this idea that when we have a strong year, at least for the headline S&P 500, up over 20% as of now, that it's not sustainable. It's going to burn out. And of course, the idea on the face of it, that's ridiculous, right? I mean, that would assume that or presume that the stock market is flat over time, that when you get a 20% rise, you have to have a equal 20% decline or even more than a 20% decline to get back to zero. That's, of course, not the case, right? I mean, the stock market's gone up a tremendous amount over almost all time frames, with some exceptions in the middle, but certainly over the long haul, the chart of the stock market is up and to the right. But that's kind of a pretty common perception, right? That whenever we have a good year, that's inevitably followed by a corrective period. But is that what history says? And I would argue no. Okay, I would argue no. If you look at the data on it, I read a piece from Ritzold Asset Management. I quote those guys all the time. For one thing, 20% plus years in the S&P aren't that uncommon. Going back to 1928, according to Ben Carlson, there have been 34 calendar years where the S&P has been up more than 20%, 34. And this is the key point, against 26 down years. So the market's been up 20% or more a lot more often than the stock market has been negative. I would think that very few people would know that statistic. Okay? So what does happen? Again, going back to 1928, what does happen when we have a 20% or better up year in the S&P? Well, the following year, the stock market was up 22 out of the 34 times that has happened. About, what's that? That's almost exactly 2/3 of the time. Stock market was down, of course, only 12 times, about 35% of the time. The average return following a 20% up year was 8.9%. And there were only 2 double-digit down years following a 20% up year, 1936 and last year, 2022. So, again, I have no idea what next year will bring, but to automatically presume that it's going to be a negative year just because we had a good year this year, there's no historical basis for that. Okay, and again, the statistics would argue it would be the opposite. And then if you look at just kind of momentum in general, a lot of people say that momentum is not sustainable, or this type of momentum is not sustainable. That could be true. Certainly, it would not surprise me, as I said 2 minutes ago, if the market took a breather here at some point, whether it's now, January, some point in the first quarter. But whenever you've had, this is according to Securities, when you've had 7 consecutive weekly gains, like we've had for the S&P 500, they went back all the way, I think, to World War II. The performance a week, a month, 3 months out was mixed. Some positive years, some negative years. But 12 months out, the market was positive 24 out of 29 times. That's a pretty good hit rate. I don't have the percentage in front of me. What's that? 80 plus percent of the time, the S&P was positive 12 months out, with an average return of about 8%. Again, that's according to Securities. I'll give you one other kind of factoid also from Securities. They looked at all the times going back to World War II where you've seen 70% of the S&P or more reach 20-day highs. So that's obviously a measure of kind of ultra-short positive momentum. Again, it's very similar. If you look 1 month out, 3 months out, results are very much mixed. But if you look 12 months out, it's actually been a 100% hit ratio. 100% of the time when you had 70% of the S&P hit 20-day highs, you've had positive returns. So I think, again, maybe there's some data out there that disproves this, but if you look at it from a historical perspective, momentum is not to be feared. It's to be respected in the short term, for sure, because the market can get overbought, overbelieved. If you look at some of the consumer sentiment and investor sentiment figures, they've gotten probably too bullish in too short a period of time. But again, if you look out 6, 9, 12 months, the results look a heck of a lot better. This would augur for probably staying invested if we get some volatility. What's another misperception that we're seeing? And I think it's timely because a lot of people are going to, coming into the end of the year or maybe in January are going to get their 401k statements and they're going to think about rebalancing. One of the biggest misperceptions is what worked last year is going to work next year. Okay, what does the average investor do? Not you, the listener, because our listeners are smart people, astute investors, wise investors. But the average person out there takes a look at their 401k, looks at the trailing 12-month returns, and rebalances to the things that did the best. Okay, I would really think twice about doing that. And this is not a negative comment about what's worked this year. We've talked a lot about how the gains for most of the year have been concentrated in a handful of mega cap tech stocks. I am not advocating for firing those holdings, the Apples of the world, the Microsofts of the world. I'm not advocating for that. I'm not even giving any investment advice on that. I'm just making the point that this has been the year of the gap, the year of the extreme. So, for example, and this is according to Charlie Bolello, he's a financial blogger I quote all the time on this show, does a lot of good statistical work. Look at large versus small. The S&P 500 is outperforming the Russell 2000, which is the main kind of small cap index that people follow, by almost 13%. In the last 30 years, large cap outperformance has only been higher twice, 1998 and 2021. How about the market cap weighted S&P versus the equal cap weighted or the equal weighted S&P, which by definition assigns an equal to value to all 500 companies? Well, the S&P has been outperforming the equal weighted index by almost 12%. This is as of a week ago. That's the second biggest outperformance on record. How about U.S. versus international? S&P is outperforming the MSCI EFA index by about 7%. That's only happened like 3 times in the past 20 years. That big of a spread. How about growth versus value? Growth stocks are outperforming value stocks by something like 26% as of a week ago. Second biggest outperformance on record going back to 1979. I could go on, but I think you're getting the point. This has been a year of extremes where kind of what they call style box asset allocation, where you're putting a certain amount in various asset classes, large cap, small cap, international, domestic, value, growth. You've seen incredible divergence between those investments. But I would be careful. I'm not necessarily saying that everything has to revert to the mean, but when you see historical, multi-decade extremes, a lot of times those things don't continue in the year going forward. I mean, I talked a couple weeks ago about how the Magnificent Seven, as they're called, are now trading at a forward PE ratio of about 33 times. Rest of the market's at about 20 times. Hard to know if that's sustainable, particularly when the earnings contribution of those seven to the S&P 500, it's much less than the market cap weighting of those seven in the S&P. That's often a sign of overvaluation. I actually read a study from FactSet just the other day that I thought was really interesting. It's the first time I've ever seen this. It looked at high valuations in the S&P and low valuations, and they found that out of the 25% of the most expensive stocks in the S&P, this is going back to 1996, only half of them on average remain in the top 25% a year forward. Okay, again, that's probably wouldn't shock you to hear that data, but it is reflective of the fact that some of the expensive, particularly tech names today, may not replicate their success next year. I mean, just look at it from a sector perspective. What were the bottom three sectors in 2022? Communications, consumer discretionary, and tech. What were the top sectors in 2022? Energy, consumer staples, and utilities. Those six sectors have completely reversed this year. Energy, consumer staples, and utilities are in the bottom three. Communications, consumer discretionary, and tech are in the top three so far this year. Okay, so I'm just making the point, and I've said this a million times on this podcast and on the radio, you cannot invest by looking in the rearview mirror. And again, it's not a negative reflection on those mega cap tech stocks in the sense that you should be getting rid of them, just making the point that diversification, I believe, works over a long period of time, doesn't always look smart on a month-to-month, year-to-year basis, but some of the things that haven't done well this year could easily outperform in 2024. Wouldn't surprise me. Kind of related to that, another misperception is that stocks and bonds are directionally correlate, because that's been the case the last couple years. I read this from, again, I think it was from Ned Davis Research. The correlation between stocks and bonds over the last 2 years, this year in 2022, is the highest we've seen since the early 90s. Meaning that last year, stocks and bonds went down together. This year, bonds have lagged for most of the year, but they're now positive, so they've actually gone up together. So the correlation between stocks and bonds of about 0.74 is the highest since 0.78 in 1994. Point I'm making here is, if you go back to 1976, there have been numerous periods where the correlation is negative, including as recently as the COVID year, 2020, where stocks and bonds were negatively correlated for most of that year. I remember 2011, 2012, significant negative correlation there as well. And if you look at it historically, stocks and bonds have been, put it this way, when you've had bonds in a stock portfolio, it's been a source of diversification, okay? In other words, bonds have many times done well when stocks haven't done as well. But so I'm just making the point that as we think about asset allocation and diversification going forward, it may be a lot less likely, based on historical measures or historical realities, that stocks and bonds track in the same direction indefinitely. Let's just keep that in mind, okay? How about a few others? I want to spend a little bit of time on this one. I think there's a common misperception that the Fed is the determining influence on the stock market. And it'd be hard to fault you if you thought that, right? Because, I mean, if you pull up CNBC or Fox News or Bloomberg or whatever you listen to, what percentage of the conversations are about the Fed and Fed policy? I mean, it's a high percentage. And, every Fed utterance from any Fed governor, beyond Chairman Powell, gets a tremendous amount of attention, right? So there's this perception that the Fed is the the 800-pound gorilla. And I would just say, listen, that's true to an extent. I mean, the Fed and Fed policy, monetary policy, interest rates are certainly a significant influence on the market. But I would say two things. One is it's just one of many influences, right? There's geopolitics, there's earnings, there's tax policy. It's just one of those influences. And secondly, there isn't a linear causational relationship between Fed policy and stocks. In other words, even if you disagree with me, even if you think that the Fed is the really and-all and be-all when it comes to market direction, very difficult to sync up Fed policy with stock market performance. To wit, the S&P is up, give or take, about 8% from where it was when the Fed started hiking rates in March of 2022. So, there's only two conclusions there. Either the Fed wasn't as influential on the market as we all thought, or maybe they were, but the stock market has already started looking past current Fed policy to what the policy might look like, 6, 12, 18 months from now. The market's already discounted that. So either way, the Fed is not as impactful as you think. And this has been going on for a while, right? If you go back to the recovery since 2008, the great financial crisis, there are a lot of people that thought that the only reason we were in a bull market in the 2010s was because of the Fed juicing the economy. The only reason the tech stocks did well, was because of low interest rates. Maybe the only reason that we rebounded from all the corrections along the way is because we thought that there was a Fed put, that the Fed would come to the rescue with lower rates anytime we had a sell-off. Those narratives are very strong. But I would push back on it a little bit for several reasons. One is the Fed only controls short-term rates, right? Fed can't control the market. Just look at the last few months. I mentioned this at the top of the show. The 10-year Treasury went from 3.3% in the spring, right after the Silicon Valley Bank, collapsed, then shot up to 5% this fall for who knows why. There may be some reasons you can articulate to me, but nobody knows for sure. And now they're back to 3.9%. None of those things have anything to do with the Fed. That was the market's reaction to whatever, government debt, inflation perceptions, future policy perceptions. And you can certainly blame the Fed for allowing inflation to get out of control following the pandemic, and maybe they should have acted sooner. But even then, would it have mattered as much as people think? I read another piece from Ritzold Asset Management where they looked at the path of inflation readings across a number of developed countries. So they looked at the path of inflation here, Germany, UK, France, Italy, Canada. And what's very interesting is you can essentially superimpose the charts. They're almost in lockstep. But each of those countries, including our own, had much different fiscal and monetary policy responses to COVID. Much different. Yet inflation rates all went up and all fell down at the same time, essentially. So can we really give the Fed credit for bringing inflation down through interest rate hikes if inflation fell in those other countries concurrently? So again, it's not that they haven't mattered. Certainly they've impacted consumer spending. Certainly the Fed's impacted the housing market here. We all know that. I read something from, I think it was Bank of New York, where they looked at excess inflation and where it came from. By excess, meaning excess relative to the norm of the last 30 years. They found that almost all of it came from supply chain shocks. Not so much from, government spending during COVID or anything that Trump did or Biden did. Much more so from just supply chains being disrupted. Of course, the Fed doesn't control that, right? Neither do presidents. So, and then if you just look at the impact on the stock market, the Fed raised 375 basis points last year. The stock market sold off. They raised rates another 150 basis points this year, and the market's had a really good year, at least from a broad index perspective. So I won't belabor the point. I think you can see where I'm going with this. As we get into 2024, I'm sure we'll be just as focused on what the Fed is saying and doing, hopefully less so at some point. But my guess is there will be other equally important, if not more important influences, such as the ability of companies to keep growing their profit margins that will ultimately influence stock prices. Keep that in mind next time you read a headline asking us to live and die by whatever the latest Fed utterance is. Number 5. Remember, I have 6 misperceptions that I wanted to talk about. How about the perception that inflation isn't going away? This has gotten politically charged, which is unfortunate, but inflation has become politicized regardless of what side of the aisle that you're on. A lot of people want to blame Biden for inflation. Others say that it's a hangover from Trump's policies. Again, depending on what side of the aisle that you're on. I would really ask you to check your politics at the door when you're looking at inflation, because it's inarguable that inflation has been decelerating. Okay, it's inarguable. Inflation was growing at 9% year over year a couple years ago. Now it's growing by about 4% year over year. That's the core rate, if you back out food and gas. Keep in mind, and I've talked about this a lot, there's a big difference between disinflation and deflation. Prices are no doubt much higher on most things than they were in 2018, 2019. Okay? So the idea that we're going to go back to those prices, that's deflation. Deflation is when you have falling prices, which has only happened a couple times in my lifetime, and I'm 54 years old. Last time was 2008 when you had an outright deflation. And guess what? Deflation came with it was the worst economic crisis in 75 years. So to get prices to roll back, I think you need a major economic catastrophe. And I don't think anyone wants that, right? What we're talking about is disinflation. The rate of inflation is slowing. Inflation is a year-over-year reading. So no, prices are not going to fall back to where they were a few years ago. But they can decelerate to, somewhere in the 2s or 3s. Obviously, the Fed would like it to be in the 2s. Over time, that's going to be better for the U.S. economy. And again, if you look at the inflation rate, I think it's inarguable that it has been decelerating. So, for example, fuel oil down 25% year over year. Gas utilities 10% down. Gasoline down 9%. Used cars down 4%. Out of all the major components of CPI, all of them have a lower rate today than June of 2022, except for transportation and shelter. And shelter, which is about 33% of the index, which includes housing prices and rent prices, remember, it works with a significant lag factor. So shelter CPI has actually moved down on a year-over-year basis 8 consecutive months. But there's a long lag time versus real-time data. So going forward over the next 6 months, that should help to keep CPI a little bit even lower than it is today. But there are others, signs of cooling. U.S. producer prices have increased just 0.9% over the past year. U.S. import prices, you've had 10 consecutive monthly declines year over year. Consumer inflation expectations, which moved down to 3.4% recently. That's the lowest since March of 2001. By the way, all this data is from the New York Fed survey, which I find to be a very reliable inflation source. So, again, I'm just making the point here that you can be Democrat, you can be Republican, you can have opinions, but please don't let those infuse your readings of some of this economic data, because I know this data is going to get manipulated for political purposes, right? Republicans are going to blame Biden. Biden's going to say it's doing a lot better and maybe even overstate how much better it's doing. We know how that's going to play out, right? I would just say as an investor, again, don't get involved, look at the hard facts, and realize that inflation, unless it reaccelerates for some reason, maybe we have another geopolitical event where supply chains get disrupted again, that's always a possibility. But barring something out of left field, a black swan, you have to believe that inflation will be in this range or lower in the coming months. All right, last misperception. And this is another kind of politically charged one, but I think it's going to be increasingly relevant for you to keep this in mind as we get closer to the presidential election. Please do not overestimate the influence of the president on both the economy and the stock market. Yes, Trump's policies, Biden's policies have been impactful in certain ways, right? Certainly on the regulatory front, the tax front, trade front. But when you have an economy as diverse and multifaceted as the U.S. economy, the president only has a limited amount of control. And the reason I bring this up is My colleague here, co-host Chase Hinderstein, is fond of saying, regardless of whether you're Democrat or Republican, at some point in the last 15, 20 years, you've been unhappy with who was in office, right? Because you've had wildly different presidential policies between Obama, Trump, and Biden. But guess what? All three presidents had a positive annualized return when they were in office. Obama, of course, was there for 8 years. Stock market averaged 13.8% annualized. This is according to Strategas. Trump, there for 4 years, 14.1% annualized, almost the exact same. And I can't imagine two presidents with more divergent policies than Obama and Trump. S&P performance over their tenure were almost identical. Biden, yes, a lot of people say he's not friendly to business, not friendly to the markets. Markets still had a positive return, not as much as in the Obama and Trump era, but still positive, roughly almost 8% annualized in the 3 years or so that he's been in office. So, again, you're going to read more and more articles over the next 10, 11 months that Trump will be good for this or bad for that, Biden will be good for this or bad for that. Understand that those things are probably not going to prove to be accurate, at least over a 4 or 8 year period, because there'll be so many other influences on stocks, on bonds, that will take precedence. All right, I hope that part of the show is helpful. Obviously, this is not an exhaustive list, but I thought these are, again, as I mentioned at the top, these are things that have been on my mind, been in my own consciousness, but I think in the collective consciousness of a lot of investors, and certainly the headline writers and pundits that I listen to. So I thought they were worth mentioning. Up next, I have a few more minutes. I just want to touch briefly on a couple holdings in our portfolio. Back in a second. Stocks and bonds are volatile, but your financial plan doesn't have to be. Have you sat down to map out an investment plan you can trust when emotions and headlines stir panic? I'm Simon Hamilton with the Wise Investor Show. Every week, we discuss the latest financial trends and what investors need to know. To learn more about how to stay grounded and to become a better informed, wise investor, listen to the Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. Just had a couple comments here on some individual stock holdings. As I always mention, one, the names that I mention are often names that I own in my own portfolio, and in today's case, these are stocks that I own personally, so you have to keep in mind and weigh for yourself whether you think that represents a conflict of interest. Also, remember, these are names that we vetted, spent a lot of time on, kicked the tires on. We felt that they're appropriate to position in many of our client portfolios, but if you're not a client, can't manage your money through the internet, right? You really need to do your own due diligence, your own research, see if they are right for your particular situation. One name I just wanted to mention because they just reported their earnings. They're on a slightly different fiscal calendar is Costco. You all know Costco, symbol COST. Here's what I'd say about Costco. There's a lot to like about Costco. Okay, from a fundamental perspective, if you look at the actual company. And I think what's been most impressive about their sales performance month in and month out over the past 5 years is their consistency. Costco has been able to put up good numbers. I mean, darn near every month over the last several years, despite, everything going on, right? COVID, non-COVID, Trump, Biden, high interest rates, low interest rates, high inflation, decelerating inflation, you name it. Costco has been able to put up consistent results. And if you look at their most recent quarter, It's reflective of that. In fact, on average, over the past 5 years, their traffic to their stores has grown about 5% annualized. Okay. Last year, 4.7%. So the last year's results very consistent with what they've been able to do over the prior 4 years. But there are some other sort of nuggets I'd like you to kind of keep in mind about Costco going forward. One is after 10 consecutive months of year-over-year declines, their non-foods business finally posted a positive low single-digit year-over-year improvement in terms of revenues. This is a big deal because we know a lot of their growing sales from food products over the past couple of years had to do with higher food prices, right? Inflation in food. If eggs cost more, their sales are going to be more when they sell those eggs, right? But now that we're starting to see some food deflation, the fact that their non-food business is picking up, I think could be a real tailwind for Costco, particularly if customers have more money to spend on non-food items. Their membership trends remain really strong. Remember, this is the kind of the anchor of Costco. It's not you and me buying 100 rolls of toilet paper. It's those monthly membership fees. That's the predictability that Wall Street loves. They've grown their total members on average 7% a year over the past 5 years, including 8% growth over the past year. By the way, this data is from UBS. UBS had a really nice write-up on their Costco's most recent quarter, so I want to give them credit. UBS also says that there is room for them to increase their membership fee. They haven't done it in a while because they didn't want to scare away customers. They wanted to be respectful of the inflation, that we were all having to deal with. But now that inflation's starting to moderate, UBS thinks there's room for a fee increase. That would go straight to the bottom line at Costco. Would also give them some room to pass along in terms of pricing. With more membership fee income, they can afford to discount a little bit more, okay, which, of course, I think would drive traffic to Costco. Just a couple other things. They continue to look to grow stores. According to UPS, they're going to open 30 new locations just in the next fiscal 12 months and look to continue that over the next decade, including a number of stores overseas where they tend to have higher profit margins. I would also say there's been a lot of talk in retail. You've heard it from Target. You've heard it from Walmart of theft, what they call shrink, shoplifting. I don't want to say Costco is immune from that, but because of their big pack sizes, the fact that you had to check membership cards at the entrance, that receipts are checked when you exit, I think that makes them less susceptible than a lot of their competitors. So those are all long-term structural positives for Costco that I think will lead them to probably continue to be consistent. What are the risks to the story? One is certainly the valuation. You're paying for this execution. So at the beginning of this year, I think Costco was trading about 34 times earnings, according to FactSet. Now they're about 38 times earnings. So this is not a value stock. This is not a cheap stock. I mean, you could argue that it's growth at a reasonable price, but it's not a value stock. And any sort of hiccups in their execution could really hurt the stock because of the stretched valuation, historically. And secondly, of course, they're not going to be immune in a recession-type scenario. So if we do get that hard landing that is being discounted out of the market, out of expectations, but is still a possible reality, then Costco, I think, would suffer along with just about any consumer stock. So there are definitely risks to the story. I'm not sure I would chase it given the strong run they've had in the past 30 days. But if you think about stocks that you would like to maybe consider for your portfolio on a pullback of some sort, whether it's a market pullback or a company-specific pullback, Costco might be one that you'd want to think about. And again, I own Costco in my own portfolio and have for a number of years. The other one I just wanted to mention kind of on the other side of the spectrum actually is what I would call a value stock, and that's Chevron. You all know Chevron, symbol CVX. And I'll start out by saying I'm respectful of our clients and listeners who don't want to own fossil fuel companies. I know some folks have some restrictions in terms of wanting or able to buy fossil fuels. Again, I respect that. But for those of you who don't have that opinion, Chevron does feel like a value stock to me. Stock hasn't done well. Chevron's down like 16 or 17% this year after being pretty good last year. And it's interesting if you look at the kind of the trade-off between Exxon and Chevron. There are years where Chevron beats Exxon and vice versa. This is a year where Exxon's outperforming Chevron. Chevron has not been a strong performer. But if you look at the company, I was reading a report from Goldman Sachs. Goldman Sachs just put it on one of their top 10 as a top 10 buy for 2024. They cited the valuation. That was a lot of it. If you look at the fact that they're trading at a significant discount to their traditional not only price to earnings ratio, but free cash flow yields. And what's interesting is that just in the last 3 weeks or so, oil's gone from about $80 a barrel to $70 a barrel, give or take. Chevron's actually gone up a few percent. That tells me that some of that downside risk might be already priced into the shares. They're also returning a lot of capital to shareholders. Goldman Sachs says that share buybacks are intensifying alongside a pretty nice dividend yield of north than 3%. They're going to probably return about 10% of their market capitalization next year to shareholders. That's a pretty nice head start in terms of their overall return profile. And expectations are pretty modest. If you look at consensus estimates calling for flat sales growth coming off this year, going all the way out to 2026, and earnings estimates have come down almost 15% just since June. So both on the top line and the bottom line, expectations are modest. And this is a company that has some of the premier oil and gas assets in the world. So the risks are fairly obvious. In my mind, it's less about company execution, more about the macro risks, right? If we go into a global recession or a U.S. recession or both, and crude oil rolls down to $50, $55, $60 a barrel or lower, where it's certainly been before over the last 10 years, I think Chevron trades significantly lower. But barring a more normalized economic scenario, if you will, I think the risk-reward probably shakes out in your favor. So again, I think the risks are the same risks that you'll have with any energy stock. It's macroeconomic risk. But from an execution standpoint, Chevron might be one for you to think about if you feel comfortable owning fossil fuel stocks in your portfolio. So again, take a look at Chevron and Costco, see if they're right for your individual situation. If you're not a client, make sure you're doing your own due diligence. That's all that I have. My colleague Chase Hinderstein will be with you next week. So as I said at the top, Merry Christmas, Happy New Year, Happy Holidays. I hope you have a safe, relaxing, and festive holiday season. And of course, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.